Hi, welcome to EQD Research, Global Insights for Friday, May 7th. Today, we're going to take a look at VIX going down in response to today's employment report, a change in the market's outlook for a potential rate hike in 2021, and I'll check in on another short-term NASDAQ 100 trade. We're seeing an awful lot of 1- and 2-day trades using NDX options. So first, as always, thanks for watching. We appreciate you checking in on us a couple of times a week. It helps us an awful lot if you hit the like button. Definitely subscribe if you haven't yet. And of course, hit that notification button, the little bell down there, which will let you know when these videos go live. So first, checking in on the S&P 500. Mid-morning, it's up around 0.75%, and VIX is down 119 to 1720. The May VIX future is down 90 cents to 1880, and the June contract is up at 21. We're going to talk about that a little bit more in a second. Down only 60 cents. You can see we've got a kind of a steep curve right now. The futures are not moving down as much as spot VIX in reaction to the employment number this morning. Now, on the trading side, early this morning, there was a buyer of 8,000 of the June 16 puts for 30 cents. At the time, the June future was at 21.25 and spot was at 17.65. Break even for this trade is 15.70, which would be the lowest level VIX has seen in some time. Now, I do think that there's some taking advantage of how much of a premium June is relative to the spot index right now. I mean, it's almost a 4-point spread. And when I see these sorts of things in the front or the second month, I always like to check in on in-the-money puts. So I priced out some in-the-money June puts when the June future was at 21 and spot at 17.20. And the table you're looking at right now shows the break even and profit if VIX is unchanged between now and June expiration. You can see I used every strike price here from 20 up to 30, used the offer price of the market, again, about 11:10 in the morning. And you can see that the break even for each of the, if you purchased any of these options, the break even is well above that 17.20 price point. If you bought the 20 put and VIX was completely unchanged between now and June expiration, you'd actually make a 70-cent profit. Going all the way up to the 30 strike prices, you can actually see that you could buy the 30 strike put, the June 30 put, for $10.30 right now. The break even is 19.70. You'd actually have a profit of $2.50 if VIX is unchanged between now and June expiration. Of course, being unchanged is not completely realistic, but short volatility is a way that a lot of traders like to approach VIX, and buying a put option is one of my favorite ways to go about doing that, because if we have another volatility event between now and June expiration, at least you know the most you can lose. You could lose everything that you pay for those put options if the puts ran up above 30 for the options that I just showed. But having a defined outcome when you're short volatility, I think that's very important if you want to stay in the trading game. So switching over to interest rates for a second, as I mentioned, the employment situation report it's being taken as a signal that inflation is not looming. So been hearing a lot of talk about inflation over the last couple of weeks. I'll leave that debate to the economists. I like to look at the numbers. Last week, I talked about the CME FedWatch tool, and we had about a 12% chance being priced in by the derivative markets of a rate hike in June or December. Well, today, and it was actually 12% for both of those dates yesterday. Today, this number has actually dropped to 7% for both days, and it's got to be, because this is the biggest piece of news, in response to the non-farm payroll number. So it looks like the fear of inflation is coming out of the interest rate derivatives, at least for the moment. I'm going to continue to keep an eye on that as we get more economic numbers and see if this employment number is an anomaly, or is it an indication that the inflation fears were unfounded? And then finally, checking in on the NASDAQ 100, it's up over 1% today. And vol Q down $1.70 to 1940. This 19 level has been a nice support level for vol Q over the past couple of weeks. We did have a little bit of a dip under 19, but we came right back intraday. But since April 15th, we've tested these levels a few times and then bounced off of them Of course, time will tell what's going to happen here. Trading wise, continue throughout the week, and I'm going to put a blog up this weekend on the EQD website, just talking about all the different trades that I've come across. But we continue to see several short-term NDX option trades. And when I say short-term, I mean ones that are put on that expire within a few hours. This morning, today about 10 a.m. Chicago time, with the NASDAQ 100 at 13,780, somebody came in and sold 100 of the NASDAQ 13,640 puts that expire today, the May 7th options, for $6, and they bought 100. They went down one strike. They bought 100 of the NDX 13,630 puts for $5.30. This is a credit of 70 cents, with a risk, if the NASDAQ does take a turn to the downside, of $9.30 if held through the close today. It does take about a drop of 1% from where NDX was when the trade was executed by the end of the day to put this trade in danger. So I'll be keeping an eye on that for the balance of today. So thanks for joining me for EQD Research Global Insights for May 7th. If you've made it this far, you got to hit the like button. That means you liked the video. Again, if you haven't subscribed, please subscribe and hit that notification bell as well. If you've got comments, feel free to leave them in the area below. If you have some more extensive questions or something you'd like me to talk about more, my email address is rhodes@eqderivatives.com, and I am always open to constructive criticism.